This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. It's hard to remember a month packed with more dizzying macro events than late January and the first few weeks we had in February. In equity markets, we've seen significant continued rotation from a violent sell-off in software stocks into tech hardware, as well as from the US to the rest of the world. And we also have a greater sense of nervousness that AI could be more disruptive to equity valuations than previously believed. In rates and FX, there's a lot going on. The strong trends of yen weakness and risky currency strength look like they corrected, only to resume trend as this episode is coming out. Commodities, they're not quiet either, with oil up 15% year to date. Gold and silver, they were spiking, then retreated. Now they're recovering again. And in just the last week, many of last year's headline-grabbing and market-moving tariff events were struck down by the Supreme Court, only to be re-implemented under a different legal framework almost immediately. With so much going on, I wanted to hear how our trading desk was managing through all of this. So I caught up with Dan Mazza, our head of FX forwards trading in the Americas this week.
Hey, man.
What's going on, Tim?
A lot.
Yeah, a lot.
That says it all. It wasn't the last time you were on the podcast. That was sometime, I think, in September, October. But the one prior to that actually came out on Liberation Day. And when we scheduled this last week, trade and tariffs were back in the news. You had the Supreme Court overturning the IEEPA tariffs that the Trump administration put in place. There's a lot of ways we can look at this, but I'm curious to get your take, and especially kind of on not quite the 1-year anniversary of this. I mean, how similar of a risk event do you think this now poses relative to something like Liberation Day? Better or worse, indifferent?
I think that this ruling by the Supreme Court is actually the opposite. This is going to dampen volatility to a pretty good degree here. So IEEPA had been seen as a way for like an immediate unilateral tariff tool where, it basically left like an open volatility on the table, right? Like there was always the chance of volatility. Now without that, you kind of decrease that tail risk that really the president has available. So I think in general, this is the opposite. We're going from a time where anything could happen tomorrow to a time where like less things could happen tomorrow. That doesn't mean that the reaction function can't be in something else that's a non-tariff, but I think it definitely dampens volatility.
One of the things we also talked about then was just looking at headlines, because of course, I mean, the episode came out on Liberation Day, but of course, we didn't know what was coming when we recorded it. And then we had the subsequent kind of 2 weeks of back and forth, and the sort of back and forth with US and China, especially where we were getting, like silly triple-digit tariff rates. And we did talk about headline risk. And so I'm curious now, if even if this is a volatility dampening event in the long run, do you still think there's short-term potential for, the dollar, as one example, has been in a range for a little while? Is there the potential for range-breaking news, or is this just, we move on from this very quickly now that we know what we're dealing with?
We have a better idea of what the future is going to be in regards to tariffs. I kind of alluded to maybe there's a different reaction now, right? Like depending on what you think the goal of the current US administration is, you could have some sort of other reaction function, some other way to make the US perceivably stronger from an economic standpoint, from a world power standpoint. So, and maybe that doesn't come in the form of tariffs. But those actions were always out there. Do we assign a higher probability to them now, or is it just completely two different independent events? So it's really hard to say. I think that, am I going to go long the dollar on this because this thing is over? Probably not. Is my bias towards a short dollar less? the answer to that is yes. I think that it kind of, weakens the stance of that short dollar bias.
Yeah, that was actually exactly the question I wanted to get to is, Liberation Day was seen as this addition of risk premium to the dollar or US assets, not the sell America trade, the hedge America trade, as we are continually reminded and as we talk about in a lot of our research. And we do have this big dollar underweight position that has been built by institutional investors that I've talked about probably more than any other of our indicators over the last 12 months. How far then does a dollar bear case go at this point? I mean, just as context, on a real effective exchange rate basis, the dollar tends to move in kind of 25, 30% cycles sometimes through history, and we did about 8 to 10 of that. Are we therefore kind of more than halfway through any kind of trend bear dollar move that you see playing out? Not, in the next week or month even, but the rest of this year, let's say.
Yeah, I think that when we talk about the dollar, or people want to talk about, DXY or the dollar versus G7, I feel like the last year the focus has been on the dollar side of it. We also have to remember that 50% of this is going to be on the other currency, whether you're talking about Europe or the United Kingdom. And I think that the other side is going to have more of an impact in the next, like you're saying, the next year, let's say,
Mm,
as of like what is going on. Like, is the UK in a situation where they have to lower rates more than what the market anticipates, right? Like, that's going to have a, however you think about it, direct or indirect effect on what the dollar's overall value is. And I think that that is going to be coming into the picture more this year.
okay.
Not a not a great answer, but I think that, like, what the fact is that, like, it's going to be more driven by the rest of the world. And I think the dollar itself, I think there's less reason to want to be short the dollar. And actually, maybe as we start to talk more, I think there's a couple of reasons popping up to be long the dollar specifically.
Yeah, yeah, we're gonna get to the rest of the G10 for sure. I have a last kind of question just specifically related to tariffs, and particularly I should say, I don't think anybody really knows where the final landing places or what the litigation in the meantime looks like. Again, we don't really know where we're going to eventually wind up. But I'm thinking specifically about this notion of refunds and reaction in rates markets. Forget about the dollar for a moment. But the reaction in rates markets, I think, was initially seen as, oh, well, this is a bear steepener because, you're going to need greater issuance to fund US deficits where tariff revenue isn't there. But we haven't really seen that. And so I'm kind of curious as to your thoughts on rates and also just the dollar liquidity, because this is also a dollar liquidity potential event. And so just kind of what you're thinking as the head of a forwards desk and how this might affect the way you're trading.
Yeah, definitely. I mean, obviously, tariff refunds will put cash back into the private sector of the market, right? Like, now, when that, like, what's the timeline of that? Like you said, there's probably a ton of litigation and a ton of paperwork that has to happen, and that's probably going to be more of a drip of money into the market, and it's probably also a drip of borrowing from the US government side. Like, and probably, in the bills market, you start to see an increased supply. But in terms of the numbers, is it going to materially change things? I don't necessarily think it's going to be that big of an impact. So I'll take the other side of it and say,
Yeah.
okay, there's been all this money that's been pulled out of the private sector. Did we really see a large impact from that? And my answer is going to kind of be no overall.
Yeah.
So if we reverse it, and it's maybe even at a slower pace, I think the impact will be less.
Yeah. The negative of not much is still not much.
Yeah.
This has not been the only risk event of the last week, of course. We've had the meltdown in software stocks. You've had all these kind of viral posts on AI and that affecting risk appetite. Do you have any thoughts just kind of for the very short run, rest of this week, next week, how this might affect the way you're managing your risk or, quoting spreads, things like that? Is this another kind of flash in the pan doom and gloom, or is it something to move on quickly from in your view?
There's a cumulative effect to it, right? Like
Mm.
we've had a couple of these, I'll say AI related scares. So as we have more and more, there becomes a greater knowledge in the market that this is either a risk that the market really believes in or a risk that the market really doesn't believe in. And you're always going to have people, disagreeing with what that market consensus is. In the next week or two, yeah, I think that there's a chance of a little bit more of this move to extend itself. I think people are really just starting to understand the power of these tools,
Mhm.
and people that haven't used them are starting to use them themselves and really seeing how it can change their role and trying to extrapolate out what could happen. So I don't necessarily think it's noise at the moment. And I think there's definitely a cumulative effect to this, and there could be some exponential growth in the understanding of some of these projections.
Yeah. That actually does segue, I think, quite nicely to where I wanted to get to on sort of long rates and duration, because fixed income markets have actually performed pretty well this year, as they did. They had an okay year last year, and that's despite the fact that you've had some sticky inflation, as we had evidence of in PCE data last week for December. But also, it was pointed out to me that this is just kind of, bonds are acting a little bit more like a diversifier. I wanted to see, do you have any thoughts? Is that kind of why you think bonds have performed so well, or are there other reasons that you think have contributed to that fixed income performance?
It's a little interesting, right? We're talking about like the 10-year in the last month is down by 20 basis points. Like,
Mm,
is that something that we generally would yeah, it should get attention, but I don't think it's anything like it's nothing monumental, right? Like we
yeah.
haven't had some like huge risk off move and the 10-year is trading, below 350 or something like that. Like that's not where we're at right now. I actually think that that's a greater possibility than people are pricing in right now, but I think that what we're also seeing is that there's just a belief that inflation, although sticky, there's really no catalyst for acceleration.
Mm,
And I think that people are really starting to think that there's more of a catalyst for deceleration of inflation or for disinflation to really start to kick in. And I think that's more of this AI story and more of also understanding what Warsh's belief system could be on how he has to maybe not react to the data, but react to what the data could be.
yeah. And let's go there then, because we have a Fed that in their own projections is saying one more cut. We had Simona from SSIM on a couple of weeks ago who's saying three. Markets are pricing in between for two. I mean, can you see a scenario where a Warsh Fed over delivers against those expectations that are priced into the market, that is?
Yeah, I mean, like in the past, we've had to see the financial conditions change.
Yeah.
Like we've had to see like a large downturn in growth or something like that. And I think that Warsh is also he's gonna want to come out of the gates with some credibility, right? Like he's not gonna want to come out and let's go back a couple months when there was a larger talks about Fed independence. I don't think he wants to go back to that. So I think there is a bit of being data driven at the beginning, but there was also going to be if Warsh believes that rates should be lower, and I'm going to assume that that's the case because Trump has nominated him, I would see there's going to be some story building. And there could be, a cut that is earlier than anticipated. One cut isn't going to change credibility, right? And then there could be a story that's built, and we could see two cuts later in this year. I think that that's completely possible. But you also need to have the data not pressing against that. You need to have the data aligning with it in some way, and you need to see that story continuing to come true. I don't think it's out of the question for us to have three cuts this year. I think that that's definitely where the risk lies.
And, on your view on duration and the potential, as yeah, you're quite right in saying the move in 10-year notes of 20 basis points, even with low levels of rate vol, that's kind of within, a standard deviation. It's not a huge move relative to what could potentially happen versus what's priced. Does that then, in translating that short end view out the curve, is it much more about the AI disinflationary story that allows for duration to perform, or is it more the financial conditions element that you mentioned that's usually what's driving the Fed, or often what's driving the Fed? I guess my question is, does it require benign scenarios of disinflation or kind of more hard landing scenarios that worry you?
What's interesting is that, and I'll try to come back to the question, is what's interesting to me is like that Warsh has talked about trying to get ahead of what the data could be, and trying to make policy adjustments that will be ahead of what we see in, let's say, 3 to 6 months. And I think that this also goes to what the administration has said, is that the current Fed seems to be behind the curve a little bit. So maybe it's a little bit of a pushback there, but I think that if this disinflationary story from AI continues to pick up, or if the cumulative effect of this continues to pick up and you have a consensus behind this, I think we could see the front end really start to, reprice lower. And if that disinflationary story picks up, we could obviously see 10-year rates and duration out the curve really start to price lower. I think what's interesting there is that we're coming into a Fed chair that is very against the balance sheet, right? So is there going to be a give and take of, I'll say, an acceleration in QT versus, much lower front end rates to support that? And then, the effect of more QT is offset by disinflation. And maybe we end up in a, like using your words, a one standard deviation move. That's very possible, and that could also make things more palatable for the market.
Yeah, thinking mechanically, again, putting your sort of money market slash liquidity hat on about QT, that's an interesting thing to bring up because there's a school of thought that says, well, you can't get the toothpaste back in the tube. The money markets have changed so much since the GFC, and we've become so reliant on abundant reserves. And yet we have a chair who's clearly focused on this. I mean, how much do you think he can accomplish? What does it take to get it smaller in an environment where it does seem that there is this dependence on abundant reserves?
Yeah, I mean, I don't think it's going to be any easy feat. Like,
Yeah.
I don't think there's a target of getting it to zero, right? There's probably a target of showing a plan that has meaningful improvement in a 5-year time horizon, right? Like something that's not going to scare funding markets, but something that can be palatable over a long period of time. And I think that's probably what we end up seeing. Like, again, it's about messaging and getting the market comfortable with it beforehand. I think that, like, that's really what the story is about. The Fed seems extremely committed to abundant reserves, or, you know, reserves at a level that doesn't create stress in the market. So I think that that's definitely going to be a concern, and they're going to have to try to come up with a plan to achieve both at the same time. And the only thing that I can see that really helps them in that is time. So it's going to have to be something that happens over an extended period of time where the market is able to react to, and also the Fed is able to change the slope of that to react to any, ill-wanted market conditions.
So that brings us nicely full circle, I think, back to the dollar because, of course, as you say, it's still probably a dollar bear scenario, but some currencies that the dollar might perform relatively well against. And it's just this week we've seen, over the last week, I guess, the dollar performing better against the yen. And where the dollar was sort of the consensus short for the year, I think the yen was one of the big consensus longs. But of course, things have not quite panned out that way, as consensus long views have learned over the last 2 years. And even this morning, we've had a reminder in terms of the potential political pressure on the Bank of Japan that they might not be able to raise rates as much as markets think they might. I mean, what's your bias on the yen and Japanese rates from here? How are you thinking about it for this year?
Yeah, I mean, I think that everyone's been trying to, play for this Japanese rates higher trade for a long time. It's been such a long theme in the market. I think at the end of the day, the Bank of Japan is going to be extremely gradual in whatever their approach is. That's what they've done. I believe that that's what they will continue to do. So playing for a huge move higher in Japanese yields, I don't think that that's necessarily the best use of your money today, right? But like in terms of from an FX standpoint, right? Like being long yen is always attractive because it's a risk off move, right? Like
Yeah.
it's your long lottery ticket, like however you want to think about it, right? You can be playing for Bank of Japan intervention, you could be playing for a spike in Japanese yields, you could be playing for a change in dynamics in the ownership of JGBs. Like there's a whole bunch of you could just be playing for a general risk off move, right? There's a whole bunch of reasons to be long yen. It's all about timing though,
Yeah.
right? Like it's so and forever being long yen has been the risk off trade and it's always been about timing. It's like it just goes back to this. Do you want to be long vol? Do you want to be short vol? Do you want to be long carry? Do you want to be short carry? Dollar yen is unique in that, it's going to carry against you, but there's going to be points in time where the risk is not balanced and people want to be long yen more and they'll have that on as just a general risk off expression. I think that it's a really tough trade because you have to have the timing perfect.
Yeah. I think the frustration we've had in trying to think about it is thinking very short term about it. But you think about it short term with a value argument behind it, that doesn't really work because value arguments can take years to play out. And so my next question is about that long term, perhaps multi year trend where you maybe have the reversal of the Abenomics trend, which was, one of the key ways global macro made money in the mid 2010s was on the back of that weakening in the yen. What sort of big picture catalyst do you need to see to get that conviction that, right, this isn't just a 5% risk off yen appreciation, this is a 25% move and dollar yen is back in, 120 over the course of the next year? What are the main things that you think have to happen to drive that?
One of the factors is, some of the ownership of JGBs, right? As that market really starts to change, like who's going to own these JGBs and are they going to be hedge positions, right? The market's going to more of a market rate on the pricing of this. So are foreign investors going to come in and really buy these things up in a market where, we can kind of say the foreign investors might think that rates are going to go higher and they might not be so inclined to do that? Or do you get a large change in the domestic market where the domestic ownership of JGBs really changes, either from a pension fund aspect, which, is a much more longer moving thing, right? Like those updates happen not even on a yearly basis.
Yeah. Yeah.
And then, from the retail community, if there's a incentive for them to not be investing abroad like they do now, if there's an incentive to invest domestically, then that's obviously gonna have a positive impact on the yen. So, I think that, like, from an investment standpoint, like, those are the things, like, we have to look for, like, big changes in the structure of that market. And I think it's happening to some degree, right? That market is changing from a decades-old norm.
Yeah.
It's becoming something else, but we don't know what that something else really is.
Yeah. Thinking about now, let's talk about we've covered the US, we've covered Japan. Let's think about the rest of the G10 and specifically on the rate side. We've talked about the potential for the Fed to maybe deliver a little bit more than is expected, the BOJ perhaps to maybe disappoint expectations. Where do you think rates are mispriced the most within the G10 now?
I wish I knew this one for certain. I think that the market is pretty well priced everywhere in terms of the G10. It's definitely interesting as you have a big divergence of what all the banks will do. You have banks like the RBNZ, and you have like Japan and Australia, like where the expectation is that rates will be higher, and then you have countries like the US and the Bank of England, where like you have expectations that rates are going to be lower, and then there's a bunch that are kind of in the middle where we're teetering back and forth between higher and lower rates by the end of the year. So one of the things I was actually looking at last week is like mean reversion is working oddly well in the
Mm,
markets. So, do you want to play that mean reversion if you think that this is a year where all the central banks are kind of constrained? Like we talk about like a large divergence in what the paths are expected to be, the absolute value of that isn't great. So it's got a pretty low volatility on everything. So maybe mean reversion is the best way to be playing this thing. We talk about why is dollar yen keep going higher? Like, there's definitely some mean reversion to that, or there's already pricing in. Like, can the Bank of Japan do more? Probably not. So you've got the idea there, and you see like the market in Australia is like from an FX standpoint, Aussie is extremely overextended.
yeah.
We're seeing things like domestic hedge ratios at extremely high levels, and can that acceleration continue? Personally, if I'm going to pick a dollar long, I'm going to pick the Aussie short right now. And some of that is mean reversion trade, right? Like I think that it might be overpriced by the RBA, and yeah, it's tough. Like you're seeing a lot of divergence, but I do think that there's a good mean reversion momentum in the market. That might be counterintuitive, but I think mean reversion is where there is trades right now, and it's just finding where everything is in its range and trying to stay on top of it.
I mean, you can kind of extend this, can't you, to a lot of other currencies and blocks of currency. So against the dollar, the G3, the dollar, euro, yen, it's all pretty flat. The DXY, as we talked about earlier, it's all pretty rangy and flat year to date. But that's not the case on some of these stories like the Aussie, but also EM carry. And I'm curious to get your thoughts in general. EM carry versus DM commodity currencies. It's not just the Aussie, it's the NOK. They're also very crowded in our holdings metrics when you look at them on a block basis, commodity FX and high carry EM currencies. So I'm curious if you have a preference, short-term considerations aside for things like the Aussie, is the commodity FX theme at least intact for this year? Or would you start to think about, no, it's the dollar maybe underperforming against the G3, but starting to outperform as a block? Or would it be EM that just looks the most ripe for a correction?
I think there's definitely still interest in being in these carry trades. The same story that I'm telling with this mean reversion in G7, it's the same story in EM or some of the higher beta, developed markets. You're still getting the same story that we're like the carry is wanted. Like we're still seeing, look at the move we've had in dollar max, like in the last what
Yep.
since the start of the year even, like, we've had a large move, and part of that is just, like, it's just people wanting carry, and maybe you can make a case that there's movement from one EM to another EM currency as people try to optimize where they're getting carry or playing RV within that. If we're in this environment where G7, or if we wanna take it a next step, like G3 central banks are really, this is 2026 might be a boring year in
Mm,
terms of, like, central bank surprises or central bank movement, then people are gonna need to make money somewhere, so they're gonna be in those carry currencies, they're going to be in carry strategies, and I haven't seen that change, I haven't seen that behavior change, and I also think, like, we've talked a lot here, and obviously the market's been talking a lot about it. There's definitely a move towards I'll say asset allocation, but, like, currencies diversification, like, out of G7, G10 into some of these more EM markets, and there the general consensus is that they're less EM from a, administration and from a policy standpoint, maybe more m more correct or more, trustworthy than some of the more traditional trustworthy banks. So, like, there's been that argument in the market, like, you can believe it or not believe it, but the flows are showing you that there's definitely demand for carry, there's demand for investment into these countries, and the allocation to these countries is definitely increasing as a general theme in the market, a more longer term theme, and I think that's gonna continue to carry out.
Yeah, it's certainly something that we're seeing in asset markets, particularly equity markets. There's a chart I will definitely throw in the show notes on that. And it's something, as you say, that has potential legs in that the US is still crowded on the equity side. EM is not. Dan, you mentioned central banks potentially being boring in the G3. That would be, I think, a welcome development insofar as nothing else has been boring this year. And this conversation certainly has not been boring. So is it Aussie dollar short? That's the one you're sticking with. Or is there anything else that stands out?
Yeah, I'm short Aussie right now. I do have a long dollar bias in G7. Also, I'm fading the move in Sweden a bit. There's some signs that that might be weakening, so I'm also long dollars there. And then on the rate side, I generally like at the moment I think I'm a little bit caught up in this general risk off theme. It could be, I'll say, underpriced, or it could also be like I talk about this cumulative impact. We could be at a point on this cumulative impact that we're seeing like some exponential thought in the market. I think the best way to play that in general is going to be long dollars, where the dollar just returning to this trade of risk off, or rates lower. Like we could go into a more of a traditional flight to quality, flight to safety type of environment.
Well, Dan, if it's anything like last year, Thursday is the day for that to happen because that was Liberation Day when you were last on the or when you were on the podcast in April last year, and we published it that day. So look for Thursday morning, Thursday afternoon, London time for that to happen, everybody. Dan, thank you so much for joining yet again.
All right, thanks a lot, Tim.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. For informational purposes only, and is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and/or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.